This is the Resilient Advisor Show with Jay Coulter.
Thanks for downloading this episode of the Resilient Advisor, where our focus is helping you simplify your business. On this show, I'm going to interview Dr. Wes Gray, the founder of Alpha Architect. Now, this is his second time on the show, and today we're going to teach you three things. Wes is going to explain why financial advisors may want to consider launching an ETF, how to launch an ETF, including the break-even cost and structures to use it like white labeling services. And then lastly, some of the challenges you might run across when launching a white labeled ETF. Wes, thank you so much for coming back on the show.
Hey, Jay, happy to be here.
Last time you were on, it was in the middle of the lockdowns. We were doing a series on quantitative investing. We talked about the value momentum factor. To this day, this is one of our most popular shows. For this episode, we're swapping gears, but man, you're a man who wears many hats, aren't you?
I am. I'm a PhD in finance that could talk about factors all the way to ETF operations. So we do a lot of stuff.
Excellent. Well, you guys recently put out a blog post on whether financial advisors and even family offices should consider launching an ETF. And I reached out to you and asked if you come on and walk my audience through this because I found the article fascinating. And I do get asked this question in our community. So what should advisors think about when it comes to launching an ETF?
Well, there's a lot of things to think about, but what I'll do is I'll just kind of highlight some of the capabilities that they may not be aware of. So what we have figured out how to do is you can take assets that may have low basis and you can actually use those as a seed for an ETF, and that transaction would be tax-free. So if you have a lot of single positions that have low basis, you have a lot of tax loss harvesting portfolios with low basis, anything really where you have a tax situation and no flexibility, we now have an ability to take those assets, transition them into an ETF structure, and allow that advisor, that family office to manage those through the tax efficient ETF wrapper, which is pretty cool. And not something that was available even 2 or 3 years ago.
And in the blog that you guys wrote, there are several things that really stood out to me for advisors to consider when looking at doing an ETF. Everything from eliminating some of the operational complexity, the deductibility, or better yet, the non-deductibility of SMA fees, and tax optimization. Could you walk us through why those are so important to consider?
Sure. So on the ops side, once you scale your business as an advisor, let's say you have 1,000 clients, it gets pretty annoying to have to update the ETF models and tax loss harvest every account. It just becomes a nightmare, frankly. Whereas if you had a way to transition those portfolios into a single ETF structure, now the only thing you really need to do on an operational side is just buy and sell this ticker. And then all that complexity of tax management, tax optimization, client portfolios moving around gets outsourced basically to the ETF operator, which is awesome. So that's operational efficiency. And then as far as the tax deductibility, so unfortunately, and this could change obviously, but in the latest tax bill, the deductibility of financial advisor fees is exactly zero. You can't deduct them. So whenever you pay 1% to your advisor, that 1% is, you don't get a tax deduction on that. So it's a straight up 1%. Where if you pay a fee through a 40 Act wrapper, like an ETF or a mutual fund, we have an ability to essentially net out your dividends, interest, and income against your fee, effectively making it tax deductible. So for example, if you have a 1% management fee and you have a 2% dividend yield, we would only have to distribute 1% net dividend income, which effectively makes the fee tax deductible, which is awesome, right? That could save you 20, 30% more on an after-tax basis for the same fee you had in an advice account versus an ETF. And then, but really the big one is the ETF wrapper itself. As many people are aware, if you have a strategy that has a lot of tax leakage because you're trading, ETFs back and forth or individual securities within the ETF wrapper, because we can essentially clean out capital gains, you can do your active strategy and we don't have to ever distribute capital gains to your client, which is awesome. Basically, get a compounding tax deferred machine.
clearly some advantages, some major advantages to launching one. Wes, based on your experience, what types of firms and what situations would drive an advisory firm to start looking at this process? And could you give some examples?
Yeah, sure. So we have a bunch of examples on our platform, and I'll give you a spectrum. So one example might be on the smaller end is someone like Colin Roach, for example. I'm sure a lot of your listeners probably know of him. What he decided to do is like, listen, I have all my clients are taxable. I'm a small shop, i.e. it's myself and some help. And so the operations are a nightmare. I'm just going to consolidate my entire business into an ETF where I deliver my investment advice through an ETF. And then my clients will still pay me on the side for like planning, and these sort of services. So that's one option. Like a small mid-range advisor, say 50, 100 mil plus, solo, just wants to simplify and do better tax for their clients. On the other extreme is we just recently did a couple converts for a firm called Bernie, another called Argent, both respectively like multi-billion-dollar advisors that used to run tactical sleeves within their RIA businesses. And they kind of did the math, right? They're like, let's say Bernie, for example, they're running a sector rotation strategy with around 130, 140 million. And as you can imagine, trading sectors is not exactly tax efficient, and it's a nightmare trying to do this for your clients. And so they reached out and said, hey, is there any way that we can convert the current assets into an ETF and then start running the same strategy through the ETF wrapper? Of course. So, and we've done that. They've launched, and it's been a great success. So it ranges from small, like not a lot of operational support advisors, all the way up to massive multi-billion-dollar advisors that are trying to contain a single strategy.
Interesting. So what about advisors who are thinking about launching an ETF? And we'll get into scalability and cost and all that, but what is the dollar amount of assets they need to be thinking about being able to commit before starting the process of a conversation?
Well, I mean, there's different degrees of that. And so I'll tell you the bare minimum. So the bare minimum, because all ETFs have to be approved by our trust. So we have our own trust. We have our independent trustees, and the independent trustees are technically the fiduciary to the trust. And so we have to pitch them to allow this RIA or advisor to run an ETF. And that means there's a lot of financial security and elements we need to consider. So typically the bare minimum to launch an ETF on our platform is $500K in operating capital and $5 million day one capital. What that means, so $500K in money that's just in a bank account to support ETF operations, and then $5 million like in the first day or two to seed the ETF. That's bare minimum, right? You don't want bare minimum. We usually recommend that you have at least $25 million day one, preferably $50 million day one, because now you're already past break even, or you're very close, depending on the situation. And they don't have to have the $500K operating capital because you're not burning any operating capital. And so that'd be a preferred route if you can get to that 25, 35, 45 type range right out the gate.
Excellent. So when you look at the services you guys provide at Alpha Architect, the white labeled ETF provider, could you walk us through what that experience would be like if I was an RIA, I had 25 million to commit day one in a particular strategy from the beginning until launch? What does that look like for the firm?
Sure. So it's a huge process, but I'll try to simplify it, right? So there's basically three things you need done when you launch an ETF. There's the like the legal stuff, there's the trading operational stuff, and then there is the marketing distribution component. Some white labels do all of them, some do certain pieces. Our offering and what we are trying to do to the marketplace is lower the barrier to entry and lower the cost to access the ETF market. So what we focus on is you show up and you just want to, usually if you're an advisor, you already have marketing distribution. That's why you have assets already, right? So we don't provide marketing and distribution services. That's not our value proposition. Our value prop is how do we provide all the legal compliance infrastructure and deal with all the trading and compliance elements so you can focus on your highest and best use, which is send us your IP. You have good ideas. You're an advisor, like we can't be your brain. So you got to tell us what to do. And then the second component is market and distribute the fund. All else is on us, right? And we're trying to minimize the brain damage tied to anything that is not your highest and best use, which is marketing, distribution, and intellectual property. The rest is us, is the easiest way to describe it.
So from a tactical basis, how does the trading work? If I'm an RIA, I have a particular strategy, say it's rules-based, and then it's time for some type of rebalance. How does that work for the advisor?
So in our platform, it's pretty straightforward. So we have a software system online you go into. You go in there, you click the ticker that you want to rebalance. It'll pull up all your current holdings and the current weights. And then you as the advisor, the operator on an ETF, you need to obviously change those weights or add, subtract securities to get what we call your model portfolio. Once you have your model portfolio entered into our system, it's going to run a bunch of automated compliance checks just to make sure you don't send us something that we already know is not allowed in an ETF. It'll say, hey, stop doing this. But assuming you pass the compliance checks, you click the button, go. That's going to get sent to our SQL database. And then our trading team is going to grab that. And then they're going to figure out how do we transition to that new model portfolio without, in the most cost efficient, tax efficient way possible. And then we obviously do a bunch of complicated operations to actually make that happen. But from the advisor point, it's literally like a point and click brain dead website that is meant to be dummy proof. So, even I could use this thing. That's the idea. And that's how we implement in practice.
So no different than an advisor jumping into Orion to go rebalance a bunch of models. It's done.
Exactly.
Okay.
Yes, it's exact same idea, except in this case, you're just running one model. And as opposed to like running a model and then getting all kinds of things you got to go click on for all the different accounts, it's literally just what's the model, click go. And you don't have to think about anything else. But same idea. You got it.
All right. And then how about from the legal and compliance side? Let's go through a hypothetical example.
Yep.
Jay Coulter, Resilient Wealth. I've got $25 million to launch. We launch. What compliance? And I'm a pure RIA.
Yep.
What restrictions do I have as it relates to what I can say about the ETF and just at a high level, and what guidelines from a marketing perspective?
Yeah, so that's a great question, and one that causes a lot of confusion just market wide. So remember, RIAs are typically registered with like the SEC, and all of their marketing is obviously governed and regulated by the SEC. But you kind of manage your own marketing program, right? You have a compliance manual that has to adhere to like your marketing rules, so you can't just say anything. But it's really you monitoring your own compliance surrounding marketing, with guidance from the SEC. And that's because what you're doing is you're not selling a security when you're an advisor, you're selling a service, okay? However, an ETF or mutual fund or hedge fund, all these are actually called, they're deemed securities. Securities marketing distribution is done via FINRA and has to run through what they call a broker dealer. Okay, so it's a whole different world. So the minute you move from, I had a service to now I have a security, all that marketing material has to first run through a broker dealer who confirms like, yes, this is good, it's conservative, you didn't say I promise. And then it goes to FINRA, who's kind of like the regulatory body that confirms it. They send it back and everyone's like, all right, good, Jay, you can go talk about this ETF. So it's a much more onerous, much more conservative process, where for managed account services, and I'm sure from seeing a lot of RIAs out there, they say a lot of crazy things, and it's kind of like the Wild West, right? And that's just because the level of regulatory scrutiny is just a magnitude less. So if you're going to have an ETF, you definitely have to have a varsity level compliance game and a mentality, because you're entering the big leagues of, having everything you say, do, or hear under a microscope that the regulators like to monitor, which is great, right? Because you have a ticker on an exchange that anyone in the world can buy. If they have a Schwab account, it's probably pretty important that how you hold yourself out there, and what you say about the product is fair, balanced, and all these sort of things. So I think it's reasonable.
Yeah, it definitely sounds very reasonable. I'm sure there is some angst when people launch, making sure they're compliant with the rules. And forgive the simplicity of this question, but if the Resilient Wealth ETF is launched and I just hold a 65 and I don't have a Series 7 or any of those FINRA license, do I have the same restrictions as it relates to talking about the ETF, or am I even precluded from talking about it?
Nope. So if you to be an advisor to an ETF, you have to be SEC registered, which is the first thing, which is unique. So even if you have only $1 million in your ETF, it's a requirement to be SEC registered. And then you obviously, if you're registered and you're providing advice to anything, you need to have either a Series 65 or a CFA or one of the check the boxes. Now, there's a certain exemption. Whereas if you don't get variable compensation for buying and selling an ETF because you're just an equity owner of your own RIA business, you don't need to become what they call a registered rep on a broker dealer. Like, I am an RIA on our own business, and I don't have a 763. I'm not registered with the BD because I don't get variable compensation tied to how many ETFs I sell, because I'm an owner of the firm. So you don't have to worry about that. That's not a huge issue as far as like licensing. You're already good to go. But as I just mentioned, there is a difference in how you can communicate. So you can only use FINRA approved materials like your fact sheet, your website, what have you, whenever you want to mention or talk about your ETF, right? Which is different than if you talk about your managed account advisory services, where there's a lot more leniency. So, but it's honestly not that big a deal. And what I found is with advisors, all it does when you have to now advise a 40 Act product, it actually makes you a lot smarter about compliance. It makes you actually understand the compliance ecosystem and why it's in place. And it just ups your game, right? It's like you were on the JV football team and now you're moving to varsity, and that kind of sucks because you got to lift more, you got to work out harder, you got to go to practice more often, and there's more responsibility, but it elevates your game, right? Because now you're in the big leagues, and so it does suck because there is more stuff to do. But for that person that's aspiring to grow their business, expand, get better, I think in the end it's actually a net positive for firms that decide to enter the varsity football team, using our analogy here.
I love that analogy. And I imagine your discovery conversations with people considering going down this path probably go like this conversation, because I keep coming up with questions that weren't even in my original question set that I know advisors want to know. So
yes.
let's say we launched an ETF at this hypothetical Resilient Wealth, and we have 25 million. It's a trend following sector rotation, what have you. But I also have my regular RIA business. And so I sit down with a client, and based on their risk tolerance and our financial planning process, they need, growth, value, fixed income, and then a 15% allocation to this strategy.
Yeah.
How is there not a conflict of interest in me recommending my own ETF?
So there is. It's called an affiliated funds conflict of interest, which is a well-trodden, well-understood situation, right? And so anyone, like we did this almost 10 years ago when we got into ETF business as an RIA, because remember, we still run like a pretty large RIA business right now, and we use our own ETFs and our own products in those accounts all the time. Well, what is the standard? Well, we as an RIA, you have a fiduciary obligation to do what's in the best interest of your clients. And so let's say that you found out like, well, I could do this. I'll take a simple example. And this is actually where it gets kind of hairy. So let's say you do a sector rotation strategy that has a ton of tax leakage, and you're not exactly like a professional train execution shop, and you charge 1%, right? You do financial planning, you run the strategy, and you're like, oh, wow. I just learned I could do this in an ETF. My clients get 100% tax deferral. The fees are tax deductible, and they're presumably going to get way better execution because it's being managed by a professional asset management shop. It's actually way better for my clients, frankly, to like be doing this fund as opposed to doing what I was doing. And so that's usually how this conversation goes. And so what happens is now, despite that, which is pretty obvious, you have a fund. Well, if you have a fund and you say, hey, client, instead of me doing this in your managed account, I'm now running this through this ETF. But just so you know, I'm charging 1% here. I'm not going to charge you 1% here as well, because then I'd be paying 2%, right? So the safest approach is you disclose the conflict because, technically you have this conflict of interest, as you mentioned. And usually you talk to the clients ahead of time, like, hey, the reason we're going to convert from an SMA to this is because it's better for you. And we always make them sign off on that. And obviously all of our clients are like, well, yeah, obviously I want to do that. So you have to manage this. There's definitely additional compliance, but in the end, it goes back to the same thing, the same principles. Are you doing what's in the best interest of the clients? When you identify conflict of interest, you have to identify and disclose those, and then build controls around them to minimize their impact on your client. Does that mean that you have to charge the exact same cost net when you launch an ETF? Not necessarily, right? If you charge 1% for what you were doing, and now you charge 25 bips for an ETF, and now the client's paying 1.25 where they used to pay 1. Well, if the net benefit to the client is substantially higher than the new cost, you could justify that. You're just going to have to, if you get audited by the SEC, they're going to say, hey, Jay, we notice you have a security. We notice you have a conflict of interest. 1, did you tell your clients about it? You say, yes, it's in my IMAs. It's in my ADV. Roger that. 2, you would want to put everybody in this ETF, and you want to go triple levered in grandma's account in Jay's ETF, show us that you're doing what's in the best interest of your clients. And you say, well, grandma showed up, she had like low risk tolerance. So based on my models, I put her at 10% in my new ETF, and it's way better because of the tax efficiency, operational efficiency, et cetera. And you keep good records. They're like, wow, that's awesome. You're actually a better fiduciary than all the other advisors we talk to. So it's one of those things where it's not like your job is to just do what's in the best interest of your clients, period. And then as long as you're always doing that and operating with that spirit, all this stuff solves itself out over time and there's no issues. But sometimes you got to have additional belts and suspenders and, because there's a lot of lawyers and there's a lot of bad actors. So it's just important that you play by the book, follow the rules, do the appropriate disclosures. But in the end, it's all about intent and your culture of doing what's right for the client. And that'll save you from a lot of problems at any point.
So a reoccurring theme here is doubling down on compliance and getting your game to the level where it needs to be to play on the varsity team. Yeah. If you're an RIA with 200 million, you're thinking you can carve out 50 million, but you don't have a full-time compliance officer yet. You're not quite at that $300 to $400 million level yet. Does that cost come into play for that type of firm?
Not really, because actually we do this all the time. I think we're up to like 33 or 34 funds launched, and we deal with operators all the way from like multi-billion-dollar mutual fund conversions to, Joe's Chicken Shack who just fell off a turnip truck and is like, I'm gonna launch an ETF. I got some money. And so we've dealt with everything along that spectrum, and we have identified very efficient, very effective ways to get your compliance up to snuff, because in the end, we're actually responsible for it at some level. So a lot of times we'll actually go to advisors, and because our systems and our approaches is so much more efficient, they're like, actually, I was paying all this money to this consultant, didn't know half the things you guys know. I'm firing them and going to use your guys' counterparties because they're half the cost and twice the quality. And so a lot of times we actually end up indirectly being like a consultant and save people a lot of money, because they just assume that the big bad compliance gremlins, you have to pay, the McKinsey consultants of the world to do it. So it's really not that bad, just because we have a lot of experience and we've kind of identified the low cost, efficient operators in the space that know how to get this done effectively.
All right. So for the advisor who's listening to this, thinking about their book and thinking, well, should I have a conversation with Wes and Alpha Architect? They're going to put together a spreadsheet before they even call you. How should they think about how they would price their ETF, and then just in generalities, and then how much of that would go to them versus the white label provider?
Yeah, I mean, so that's a super complicated question, obviously, but usually you want to price your ETF where it's marketable, obviously. Like, depending on what you're doing, you want to make sure that the price you're charging, you have a value proposition, right? So, if you have a closet index SB 500 fund, you probably don't want to charge 1% for that. You might want to charge 10 basis points or something. And then, you could do the math and everything in between, but Generally what we see right now would be active. Like we don't need another S&P 500 fund, right? But a lot of advisors, a lot of asset managers out there have unique, very boutique kind of active strategies, or they got fund of funds strategies that are pretty cool. And because they actually just involve work, time, they're not just another Vanguard fund. The pricing is all over the map, but usually the range of 30 bips to 80 bips, depending on what you're doing, is reasonable because that's fair. You're doing a lot of work. You got to get paid for your work. So that's what I'd say on that component. And then as far as our platform is concerned, so our platform is a shovel selling platform where our job is to give you as much operating leverage as possible so you don't have to go burn millions of dollars on fire to set up your own ETF infrastructure, right? Your job is to get to break even, and then we can offer you very low marginal cost production, which means that if you can get to break even, your gross margins are 80, 90%, right? It's a money machine. And that's what we're trying to do is like, how do we get that break even cost as low as possible and then keep our ongoing cost production as little as possible? So if you scale, you make a lot of money. We want our operators to want to get rich and gold mine, right? We'll sell you an awesome shovel, and we would love for you to continue to be able to pay for this shovel for the next 30 years. But we don't make a ton of money in the white label business, right? It's a shovel. It's a service business. So it's great because we have enough operators, we have enough scale to make it work, but we're not getting rich doing this. The gold miners get rich, and they should get rich. Those who launch ETFs, who take that risk, who put the effort in developing IP, doing the marketing, doing distribution. If you make $100, $200, $300, $400 million fund, you deserve to make a lot of money because that's a lot of work. And our platform is designed to give you those riches as long as you were able to pay for that shovel, right? We're not. Sometimes we do entrepreneurial deals where if you have a really, really compelling pitch and you're like, hey, this is pretty entrepreneurial. I want to take a much lower fixed cost, but I'll give you guys more of the bips out in the tails. We will entertain that in very, very unique circumstances, but that's not the intent of our platform. Our intent is to be a shovel salesman and let you get rich on our platform, essentially.
Yeah. Wow. Like I said, answers just generate more questions. All right. So let's forget about the advisors that listen to this show. All right. They're hard charging folks. They start thinking about an ETF. Not only are they going to be thinking about how they could monetize that ETF inside their own practice, they're probably thinking, I know a network of other advisors. Are there use cases? And I'm sure the answer is yes, but I'm curious what the use cases are for taking the ETF outside of your own shop after you launch the white label product.
Yeah. So, I mean, the easy thing to answer, which is actually complicated, but it's way easier, is just like, well, this is just better for my clients. It lowers my operational brain damage and everyone's saving on taxes and you get all these great benefits. But then if you're willing to go down this path of increased compliance issues, increased cost on like the operational costs, et cetera, you also have this other benefit where prior to launching ETF, the only way someone could access your brain power and your services is they got to, open up an account at Schwab, set up, sign the IMA, the investment manager agreement, huge pain in the, whereas now there's a ticker, right? It's like JETF at Schwab, Fidelity, TD Ameritrade, Interactive Brokers, wherever you trade. And anyone who likes your idea or likes what you're selling, they type the ticker in and they're a proud owner of it, right? So the distribution scalability and access ease is crazy. And so to the extent that you're someone who has a reasonable idea, but you have other advisors who might be interested, or you just have clients that it's just a huge pain to service them, it's a lot easier to say, you know what? No need to open an account. You see your Schwab account, type in JAY and click go. Talk to you later, right? That's kind of the idea. If you want to make a business as well, besides just helping your own clients, there's obviously a huge case, and that's a well understood and trodden path. That's the Cathie Wood path, which is obviously awesome if you can achieve it.
Awesome. So Wes, I really appreciate your time. I appreciate you coming on. I've learned a lot. To learn more about Alpha Architect, the research they provide, the ETFs that they have, and their white label service, please visit alphaarchitect.com. Thanks again, Wes.
Yep. Appreciate it, Jay. Look forward to talking next time.